All right. Good morning, everybody. TGIF. We got non-farm payrolls today. That's very likely going to offer us an opportunity for a gap close play. We'll get into that. It's not a gap in price like you would think of, say, yesterday's close at 4 o'clock and today's open at 9:30 and trying to trade the price gap back to the previous day's close. It's not that kind of gap close. It's a liquidity gap. And I've demonstrated this before. It shouldn't be new to anybody who's watched my briefings for a while, but there's always somebody new. Doesn't hurt to review. So we'll get into it. Right now, we're looking at the CME group. You can find this page if you just Google FedWatch. It's free. It doesn't cost anything to go over here and look. And you can look at it whenever you want. It doesn't do any good, really, to try to stare at it all day long. This has the FOMC meetings across the top. The ones in gray are for next year, and they're not quite set in stone. Those dates could shift just a little bit. Not a lot, right? A couple days, maybe a week in one direction or another. The thing you want to focus on is what the changes have been. And you look in the lower section, it shows where we were a month ago, a week ago, 1 day ago, and where we are now. And then it gives the projections. If you're not used to looking at this, there's an area on here where it says current target rate, gives two numbers, 425 to 450. That can be confusing for people, so I often just recommend pick one of those numbers and focus on it. It doesn't really matter which one, it's up to you. So if we focus on 425, that says that's where we're at now. And we're looking at March 19th. And we can see that we have a 91% chance that at the March 19th meeting, they won't cut rates, and we'll have the same number after March 19th that we have right now. So they're projecting no cut. If we look down below, 425 to 450, we can see that the chances of us not getting a rate cut from yesterday to today went up from 88 to 91. But if we look back over a week, it was at 92 a week ago. Now it's at 91. So it's gone down a little. In a month, it hasn't really moved all that much. It was at 92 a month ago. So there's really been no change from all of this rhetoric and behavior and tariff talk when it comes to, hey, are we going to get a rate cut? Not in March. But there has been talk over the last week of how many cuts are we going to get for the year. And this has been something a lot of analysts have been batting back and forth. Maybe we'll get two, possibly three. And there's always extremes. There's always an outlier analyst, some who say, oh, we're not going to get any rate cuts. And then somebody else that says, yeah, we'll probably get five. Then there's the size of the cuts. Is it going to be a 25 basis point rate cut, maybe a 50 basis point rate cut? So rather than trying to catch the headlines and chase the news and figure out which one of the analysts has a respectable history that you may want to follow when they have something to say, you can just come here and look at it for yourself and see, hey, they can talk all they want, but where are they putting the money, right? Follow the money. This is trading contracts, right? So that it's monitoring the contracts and it's looking at where is the money going. So if they start bidding up these different contracts, then we get a better sense of what the market is spending when it comes to their projections. You ever heard the phrase, oh, yeah, I didn't know that was already priced in? That phrase used to really just frustrate me when it came to non-farm payrolls, earnings, really anything. And especially when it comes to FOMC. And we would get a rate cut or we wouldn't get a rate cut or we'd get a hike. And someone would say, oh, yeah, no, that was already priced in. How did you know that? Where did you see that? This is the answer. This is where they saw that. So you can see what the market is doing. You can see if they're pricing in a rate cut or not. And like I said, you don't have to come here and look at it every single day. You don't have to stare at it all day long. Maybe just stop by a few times a week or if there's been a significant change to the price in the market, right? If we get a big sell-off, we get a big rally, come in here and take a look and see if that rally was associated with a significant change in a forecast for rate hikes or rate cuts. They are right now pricing in a total of 3 cuts for the year at 25 basis points apiece. That's what we're seeing. If you were to go through all of these into the December and just look at each one. And like I said, to make it more simple, just pick one of those numbers. So if we just pick, say, 4 1/4, then when we come down to the lower level, pick that same number. If you pick the front one, then look at the front one down here. If you pick the back one, then look at the back one down here. So they are pricing in 3. There's a difference between getting a rate cut because they still think that we're, not at a neutral rate and we're still restrictive, and they want to just ease things after having been, in the 5 area. There's a difference between that kind of cut and a need to cut because the economy is slowing down and they squeezed us too hard for too long and they broke something. So, getting a rate cut on one hand can be really good. The markets will rejoice. They'll say, thanks. We were still in restrictive territory. Maybe we're getting closer to a neutral rate now. Versus the other one, which is, uh-oh, something broke. It's getting really bad out there. And they got to come in and play save-a-ho and start cutting just to stop us from crashing and burning. So when it comes to a cut, why we cut and the language behind it, the rhetoric they use, the tone, that becomes really important. If we look at what's going on around the world, the US is up, or at least in the green. Everything else is in the red. This Japan 225 is wrong again. It's becoming a consistent theme. So at least they're consistently wrong. We just don't trust it. You can always jump over to TradingView, Thinkorswim, whatever platform you have, and you can see they're down around 2%, not 6%. Otherwise, the Dow is flat, small caps at about 1/4, S&P flat, and the NASDAQ, they were closer to 1/4, but they were just waiting on that jobs data. Remember, the Fed's mandate, come back to that for a moment, it's a dual mandate, right? One side is inflation, the other side is jobs. And it's a tug of war. Those two, if they get jobs dialed in to a really high level, then something breaks. And if they get rates too high, then something breaks. They get it too low, we get too much inflation. It's just a back and forth, right? Back and forth. They have to try to balance all of this. They had claimed victory on inflation and started to focus a lot on jobs. And now with the new administration and possibly tariffs and all the rhetoric about costs, we're seeing them struggling more with rates again and possible inflation again, while at the same time, all these layoffs in government, it's going to lead to private sector layoffs, and then it's going to hit jobs, and they're in a pickle. So the jobs numbers today are very likely not going to be as heavy as they're going to be next month because they really just started getting into it, and the data is always delayed. Sure, this is March, but we're getting February's numbers. We're not getting March's numbers. So in April, we'll get March numbers when those layoffs in the government and every contractor that was tied to that really starts showing up in the job numbers. But there has been a couple of analysts who's already said we may see some of that already in the February numbers, but it's more likely we'll see more of it in the next one, which is why payroll today or non-farm payrolls are worth paying attention to. So we can see high impact, a lot of red. After we get the unemployment data, we've got a lot of Fed speakers even into the afternoon. But once the last one is done, Krugler at 1 o'clock. The afternoon should be free, other than we have a crypto summit today. It's going to be coming out of the White House. They've got influential leaders from the crypto industry, founders, CEOs, investors, and they're going to be discussing regulation and innovation. Yeah, whatever. That just sounds like somebody wrote it up really nice. The acting chair of the SEC, acting chair of the CFTC. So who knows? We may get something out of that, but that'll be running through the day. It starts at 10:30. It ends at 2:30. So even when we're done with Krugler here, there'll still be a little bit that we could see some volatility from the crypto summit today. There's still a lot of worry on the contagion that's coming out of Germany and it's spreading. The amount of money that's flowing in that direction and really just all across Europe into defensive names. And I mean, Germany had to vote on a change in their constitution to do this, right? It's a big deal. And their markets don't like fast, sudden change. If money is piling heavily into Europe and into bonds, where's it coming from? Right? That's always the rub, is the capital rotation. So continue to keep your eyes on headlines about Germany and their change in spending posture and these bonds and anything connected to that, which might tie in with the surrounding countries, their rate hikes, their yields. It sounds like a lot, but really it's not too much, just a couple of headlines. All right, a liquidity gap close. We got examples of what we don't want to see, and we have examples of what we do want to see. This is a CPI example. Happened at 8:30. There's really no wick on the bottom of this. So at 8:30, it moved in one direction, and it closed in the upper half of that candle. If we think about, say, a dollar, it has 4 quarters. We take a candle and we break it into 4 parts, we'd have 4 quarters of that candle. We want price to close in the upper quarter of that candle. Now this one, in this example, it closed in the upper portion, digested a little bit, and it just kept going. It never came back to close the gap. So I wanted to start with this one because I was told I wasn't showing a failure to close the gap enough. In the other examples I'm going to show, we get a really nice gap close. But that's not, just because we get the setup doesn't mean we're going to get the gap close. So here's one where we got the setup, almost no wick on the bottom. It closed in the upper 25%. It didn't really base all that much, but it came back down to where we started. And we got there around 10:30, 11 o'clock. Here's another example, non-farm payrolls from October. Not much wick at the start, closed in the lower 25%, built a base, got the gap closed around 11 o'clock. Or another example, CPI, big move, not much wick going in the other direction, closed in the upper 25%. It actually took a little bit of a pause, and the next candle was stuck within that wick or that range that we built there. Then we continued the move, built a base, came back down, got the gap closed around 10:45, 11 o'clock. This is what we don't want to see. Pretty obvious, right? Big wicks in both directions. Price closes near where it opened. There's not much of a gap to close if after we get the data and we make big moves, we close just about where we opened. What's left to, what gap do we have to close at that point? Another example here, big wicks. We closed near where we opened. Or another example, big wicks. This isn't what we want to see. However, no matter which one of these candles we get today, whether it closes the gap, whether it doesn't close the gap, leaves a big wick or not, we can measure the entire range of the big 830 candle that we're going to get using a 5-minute chart. And then we can project that 50% higher, 50% lower, or 100% higher and 100% lower. And no matter which direction we break out, price should hit and respect those levels. So in this picture, if we measured this entire range and projected to the downside 50% and 100%, it's very likely going to match up with where we paused in that move. Or here, if we measured the entire thing, plotted it to the upside, 50%, 100%, very likely where we topped out. And on the fade back, if we were to mark the midpoint of this candle, it's very likely where we paused here or here. Right? So even if these candles today doesn't give us a gap close setup, it can still give us guidance on the day. We're still underneath the volatility trigger, zero gamma, and the call wall. Zero gamma is getting left behind. The call wall is being rolled down with the volatility trigger, and the put wall is back below us, 56.61. Of course, to get to it, we would need to break outside of yesterday's low and then continue to the downside. We've got some COG levels down there and round number 5,700 that we would have to get through. Not to say that we can't do it, but we had a range that we've been working on since Tuesday, and we broke out of it yesterday and we got back in here again. It's likely that if we break this range that we've been working on since Tuesday, if we break it again, that we're going to retest that 5,700. Now, that's been my line in the sand all week as a line that we don't want to cross. And if we cross it, we certainly don't want to close below it. So that's a level that I continue to keep my eye on as a line of last resort. I think if we get below that, we'll punch through this put wall like it isn't even there, and we'll get a real sell-off. We haven't had one of those in a while. A sell-off that's so strong that it triggers lock limits and the futures go in halt mode for 15 minutes. Yeah, that's a thing, right? So you can call it a flash crash, call it whatever you want. It's on the table if we break that 5,700. Good times, right? So we are within the ADR half. That makes sense when we have a big economic event like non-farm payrolls. The markets will often go sideways waiting on data. We can see that we have a market maker move this morning. So they're hedging into this. The idea is they're already hedged. They're always hedged. This is extra hedge. It's extra insurance, and it's nothing but cost for them. They won't spend that money to protect their position if they don't have to. So they are hedging this morning because they're worried about the outsized move, and they have no idea what direction it's going to go. If they don't know and they're spending a bunch of money to hedge, we have no way to know, right? If they can't do it, we can't do it. But we don't have to, right? We don't need to guess or assume that we know what direction it's going to go. All we got to do is focus on the fact that at 8:30, we're very likely going to get a big candle, and we can mark that candle out, project its levels, and play a gap close play if it's offered, or a continuation play if we begin to expand further in whatever direction we initially started. Using just the RTH of yesterday, you can see the halfback is offering us some insight this morning. That line won't mean anything at 8:30 when we get data. Pivot points get run over by extremes. It is worth noting that we got there and we weren't able to get through it, but we got to get the data, and then we got to see how the market takes the data. So it's likely if we can get through the half on the data and it's just a spike, then we'll just use the gap close play that we had already talked about. Otherwise, if we get the data, we spike around and we still end up within a range, say it's one of those big wicks on each side, but we really don't go anywhere, then we would be pretty much sitting where we are now, and we'll focus on getting above or below those ADR half lines. And both of them are inside of yesterday's range, so we can hit either one easily. We have a market maker move. That's how I know they're hedging this morning with additional hedges. We believe it's because of non-farm payrolls, and that's a pretty good assumption, but it's still just an assumption. So after 8:30, this number should start to go down. This thing has a life only for today. The contracts that they're trading are going to expire today, so we know that this is not designed to be here longer than today. As the day goes by, it's going to shrink anyways, whether they like it or not. But if it's only because they're hedging non-farm payrolls, it'll start to shrink really fast after 8:30, and it'll probably be gone by 10 a.m. If it's not, and it doesn't start shrinking after 8:30, then that tells us it wasn't non-farm payrolls that they were hedging, that there's something else. We don't really have much else today, right? We got White House stuff, the crypto summit, and a lot of Fed speakers. So maybe it would be one of those, or maybe there's still something else out there that the market is worried about that we don't know about. It's always possible. So just keep your eye on the market maker move after 8:30. See if it starts to shrink the way it's supposed to. And if it doesn't, then we're not done with whatever is scaring the market. Today's floor pivot opened significantly lower than yesterday's. That's bearish. Price opened underneath the floor pivot, and that's also bearish. But we haven't hit that floor pivot yet. We haven't touched it. So we have an MDP, missed daily pivot. Markets hit their pivot 80% of the time. So another way to say that is we have an 80% chance of hitting that line today. But we could hit that at 8:30 when we get non-farm payrolls in just a wiki spike. It would still count. We hit it, but we haven't yet. Even if we do get it, we got to get on the other side of that channel if we're going to get any hope of an expansion. And we have two floor pivots side by side. So this is going to be a difficult level to get through if we do get up into that 58.15 area. We left a pretty good range from Tuesday into Thursday. So we got a lot of trash to work through if we're going to try to run our way back up again. S1 is outside of yesterday's low, which kind of ties in with if we were to draw out yesterday's 111 and consider a reversal on a breakout of yesterday's low, it's going to line up with 5,700. It's going to line up with the S1, and it's going to line up with the 1236 or the 111 reversal. We can add and to that multiple times. An inside day breakout of yesterday's lows around 5,700 looks like a really good reversal point. But that's been our line in the sand all week, and it's a line that we really need to keep anyways, 5,700. All right, the profile on the week really isn't offering much insight. It's really wide and it's really full. That's about the best that we can get out of it. Other than that, the point of control has been brought down to our current location, but we've spent a lot of time here this week, so it makes sense, right? From say Thursday afternoon into now, we've got all those candles down here, and we've got a lot of volume down here. We're at this level, so as long as we're hovering around this zone, it won't be supportive or resistance. So there's our line in the sand. And there's the low. We can measure this distance and plot that to the upside. It's called reciprocation. This is now our zone. And we can just cross back and forth through that point of control all we want. It won't act as support and resistance. But once we leave this range and then we come back to it, then it would begin to act as a resistance or a support again. The problem is it's Friday. So even if we leave the range, we're not going to get very far away if we're going to also make it back to that level today. So that really says that on the week, this profile doesn't really have much to offer us. The only thing else that it can offer is if we do break to the outside, to the upside, and we manage to get beyond reciprocation and we just keep driving, say above 5,800, that we came off of a strong structural level, and since it's below us, it's not overhead that we're going to hit it. Yay. So that's about it, right? If that's the silver lining, it's not much. Ten-day, 30-minute volume profile with TPO. They're lined up nice, but we're still not getting into those candles yet, and we don't have anything that can move this point of control anytime soon. We haven't started to build out a new price shelf anywhere that's even remotely close to this size, and we're not near these candles. So that point of control isn't expected to move, at least for a week. And the only way that it's going to be interacting with us is if we run back above 5,900. That's a long ways off because we got to get through 5,750, 5,800, 5,850, 5,900, 5,950, and then we can get to that. That's a lot. I don't see that happening anytime soon. We don't have a VPOC for today because we've cut through it, but we've barely interacted with it at all. And the textbooks say that you should carry forward the point of control every day. I only carry forward the VPOC. I'm not interested in carrying forward every single point of control because I've got enough pivots. I don't need more. But there is times where it's worth marking that level out, even if it isn't a VPOC. So I'm going to mark that level today. It's not being marked as a VPOC. It's just a POC. It's a point of control. It's the greatest amount of volume from yesterday. And we don't have to add any sort of bias to that statement. It's where the greatest amount of volume took place yesterday. The end, period. That's it. But we can get something out of that. We can consider it from the perspective of trader's remorse. If that's where the greatest amount of trading took place yesterday, and we go back there again today in regular trading hours, it's likely we'll see more trading activity at that spot. So I don't have to call it support or resistance or imply that it will act as support or resistance. We can just say it's an area of interest. It's where a lot of trades took place yesterday. It's where the most trades took place yesterday. And I want to be mindful of that level if we revisit it in regular trading hours. It's 5750 anyways, so it's a big round number you would already have marked, but it's also a point of control. It's just not a VPOC. The range that we've established this morning is really narrow, which is what we would expect in front of economic data. They're sitting on the sidelines doing as little as possible and waiting on news, just like the rest of us. And they're hedged to the eyeballs. We've got an example of what next week's range will look like, but it's not set in stone yet. It won't be set until after the close today. It doesn't mean we can't get some early guidance, though. We can measure the range that we had this week, and we can compare that to the range that they are projecting for next week. And we can see that next week looks like it has a lot more volatility in it than this week. Now, again, that's not set in stone. By the end of the day, the range could shrink considerably, and then there wouldn't be more volatility priced in for next week. Next week is OPEX, I believe. No, next week is the government shutdown. That's what's on the agenda for next week. There's a threat of a government shutdown by March 14, and also a full lunar eclipse on the 14th, which sounds pretty cool. A blood moon. And OPEX is the third Friday of the month, so it'd be on the 21st. So it's very likely that this volatility or the range that we have here is because of the threat of a government shutdown. We've already begun trying to work our way back from the lows, or how far down we were below the 10-day moving average. We're still below 2%, and markets crash from an oversold level, right? They don't crash from the highs, from an overbought level. They crash from the lows, and we're still at those lows. So we can crash from here. In fact, if you look back at where some of these extremes went, -3 and some to the downside, it was at a -2, and then it just crashed really, really far. Right? So, when you think about the history of the markets and some of the worst behaviors we've ever seen, it comes from that sort of example, that we get bad and then we get really bad, because crashes come from an oversold condition when we're already down a lot. So we are working our way back up, but we've been working our way back up before, and that didn't get us out of this mess. So we're still in a dangerous area. We need to begin working our way back towards the 10-day. And if we wanted to consider it as such, we could say we are oversold, but that doesn't mean that we have to go back up. I don't even like the phrase oversold and overbought, because it implies that we've sold too much. Well, there's no such thing as overbought and oversold. Now, you can't buy too much, can't sell too much. There's just price action and price behavior. We've moved a long ways really fast in a short period of time. That is the risk. And because of that, we could revert back to the mean sum, a little bit of least squared method, back towards, say, a -1%. Looking at the 10-week, we're more than 3.5% below the 10-week. And if we just put the mouse there and look back, the last time we were this far below the 10-week was back here in the bear market of 2022. And things got pretty extreme. But it took months for us to get that negative last time. We've managed to do that this time in less than, say, 2 months. So when we talk about moving really far, really fast, well, that kind of highlights our dilemma. So again, that implies that we can flip around and get a move back to the upside, not a healthy sort of market rally with everybody cheering and taking on risk and being real happy about it, just more of, say, a reflexive bounce. Some of the biggest up moves in history, some of the largest bullish candles you'll ever find, were printed in a bear market environment. I know it might be a little bit of a catch-22. So looking at things that are down, nat gas is down more than 2%, but that's a healthy pullback because it was up 14% over the last 5 days. So getting a 2% pullback now is kind of a good thing. That was a big run. The Mag 7 down volume had been up over 20%. I know there's a lot of conflicting words there. It's the down volume in the Mag 7, and that down volume was elevated. Well, the down volume is losing some of that elevation this morning. So the Mag 7 is a little less weak this morning, but it's still really weak. Looking at things that are up, we got the VIX, gold miners, uranium, bonds, chips, a little bit of China, not much, and energy. So it's scattered. We're not seeing a lot of China in here, but there is some. And XLE energy is really generic, right? It's got a lot of stuff in it. It's odd to see gold miners up this morning, but silver's not up this morning. Having said that, though, silver did make a pretty decent run and is still sitting at 29.5. So crude is up more than 1.5. Nice little reflexive bounce. This is a red to green that is worth paying attention to today. It's the kind of red to greens that I like. So if we look at yesterday and the way that it dipped down and ran back up and then closed, and it has gapped way up here now. The rally started yesterday, right? And really we had 2 days of defense or underneath that 71 level. They bought it back up again. But this morning, it actually ran all the way up outside of yesterday's range and then opened and went even higher. Now, sure, we're fading back a little bit this morning, but that's a nice start. So one condition we can use is yesterday's high. It's about $72, good round number. If this is going to stick, we would not want to get back inside of yesterday's range. And then if we do get back inside of yesterday's range, we could use the half back of yesterday. Now we have a bigger candle. So if we were going to do a half back, it'd probably make more sense to measure that bigger candle's range. Call it 71.5 if we just want a simple round number to focus on. And if we move the drawing to the smaller candle, it's 71.64. And it's close to 71.5 either way. But I think that bigger candle's half back probably has more validity for the half that we want to pay attention to. Even look at yesterday's price action. When we tried to rally off those lows, the previous day's half back, that big bar I'm talking about, is what we stalled on and we weren't able to get through. Then we went into the close and we had this big breakout in the overnight. We're sitting way up here. So if we fall back inside of yesterday's range, let's keep it above that 71.5. Otherwise, this is just a dead cat bounce and a continuation of the move to the downside that we've been working on since January. Pot stocks still look like some triple leveraged inverse volatility type product because all it does is bleed and bleed and bleed. No change today, even if it is showing positive. This is more of an event-driven product. You want to find opportunities to trade this when there's pot investor conferences or changes in legislation, anything happening on Capitol Hill, that sort of stuff. Otherwise, there's nothing in there. That's trash. And again, we do have miners this morning, but we don't have silver. It's a little weird to see gold up, miners up, but we don't have silver. It's very likely that there's a discrepancy in there based on either a silver company that was negative and went down, or a gold company that had like a good earnings and went up. That would be more likely than the underlying being split between those two. So look for one of them to revert back. Either gold and gold miners and all those guys actually start following silver to the downside, or silver flips around and tries to get caught back up with its precious metal group to the upside. And with the China names, KWEB is not up even 0.5%, and emerging markets isn't either, which is also China. So we've got some China stuff, yeah, but not as much as we should. It's Friday, and it's a really big Friday. So watch the headlines. Be careful. Be safe. I'll see you on Monday.